Okie dokie. So tonight I wanted to kind of go over a little bit of a basic overview stuff. I've had some people ask me some questions that I want to make sure they know how to do, because they're probably a few of the most important things to do to trading. And then we'll get into some other stuff later on. But you know, I wanted to first start out with just a standard order, how to do an order entry. If you're using E-Trade, if E-Trade's your broker, there's no reason not to be using E-Trade Pro. It's just a simple download from to show you how to set it up to look just like mine. I've got my little scalper screens that I use. I got some stuff that I use for, you know, my swing trades with different tabs set up. Yeah, that Apple and IBM announcement today shot Apple up really good at the end of the day. I've got a general research script that I use. And we're going to go through just really quick showing you how to enter an order, because quite frankly, you need to know how to enter an order. You can't buy or sell stock without knowing how to do it. So there's a few different ways to do it. I'm going to go through the easiest way if you're using E-Trade. And just so you know, it's an SEC titled the same way. So regardless of what broker you're using, you'll be able to follow along. You know, I can go through with the major brokers that I have experience with. I know a few of you, Tammy, use brokers I've never heard of. But anyway, the SEC regulates how the orders are done and what they're called and this, that, and the other. So what you're going to see me do is what I believe to be the easiest way to enter an order on or using E-Trade Pro. If you go to your tools window, or your tools tab up here, you see it pops up, and you should be running a market depth. That's your level 2. And you can do, there are many other ways you can do it, but this is the easiest way. On your market depth, which is this right here, the level 2, you'll actually see down at the bottom, there's a little arrow by it. Click that, and you have an order box pop up. Now let's say I wanted to buy 1,000 shares of Yahoo right now. A couple things I'd want to verify is whether I was doing limit order, market order, something like that. But I prefer you buy with limit orders. If stuff's moving really fast, let's assume Yahoo was moving like crazy right now. I might want to put it in at like 34.95. The term where it says, you know, day, that means if it doesn't fill by the end of today, it will expire, the order will. Dog, right now I'm just on regular stock, and then I'll get to options. GTC is good, technical term there. Good till canceled, meaning until you actually cancel the order will remain there waiting to fill. FOK, fill or kill, means it fills it. I don't use those types of orders, but it's a set amount of time. I think it's like 5 minutes. If it doesn't fill it in 5 minutes, it kills the order. And then IOC, quite frankly, don't know what it is. I don't use it. I use day or good till canceled. Your destination block. If you're trading Yahoo between 9:30 a.m. and 4 p.m., what would we call that? Between 9:30 a.m. and 4 p.m. Eastern Time. It's open, right? So your destination can be auto. If you need to do a pre-market or after hours trade Why would you need to want to do a pre-market or after-hours trade? I mean, I don't think you should be in the habit of doing a whole lot of pre-market and after-hours trades, but why would you want to? Yeah, something like earnings or some news that comes out. You know, about a year ago, I was in JRCC, and they released news. It wasn't earnings related, but news after hours, and the stock collapsed. You had to sell it after hours there. But if you're doing that, you're going to want to change the destination to like ARCA. But just remember, when you trade in the pre-market or after hours, there is an extra fee for it. And no, American brokers, Dan, I don't know for UK brokers, but American brokers, there is no special authorization. They're actually required by law to provide that. Well, I thought you were in England. Anyway, so if you're doing it during the day, you have it on auto, you put in your price. You know, this would make my order kind of go like a limit order or a market order, but it's restricted. It won't be one of those fat-fingered market orders that goes off at like 300 bucks. I'm telling my broker they can buy at any price at $34.95 or lower. And it comes up with a confirmation. If I wanted to sell it, now, if I tried to sell at $34.95 right now, there's a chance I won't get filled, right? Why would there be a chance I wouldn't get filled right now if I tried to sell at $34.95? Yeah, I mean, that's above the asking price. So, I mean, the bid could keep getting lower, right? So if I wanted to guarantee that I was going to get out, and let's say I've got 1,000 shares, to guarantee I'm going to get out, well, I kind of got to do some math, right? 300 plus 200, that's 500, plus 100 is 600, and then there's 500 here. Well, I need all of that. So I've actually got to put this in at 34.65 if I want to guarantee that I get out right now. I hit the sell button, and what my broker should do is fill 300 shares at 34.78, 200 shares at 34.71, 100 shares at 34.68, and the remaining shares at 34.65. But remember, what does not show on a market depth? All or none orders. So there may be some other hidden orders in there. But if I wanted to ensure I was going to get out without paying for separate transaction costs, I would need to put this. If I had 1,000 shares and I wanted out right now, the only way I could sell all 1,000 shares guaranteed is to put that order in at 34.65 right now. Again, limit order, the price I want to sell at, the term I would use just day, the destination, if it was during market hours, auto, button, and then prepare for my exit. Does everybody understand just how to enter a basic stock trade order using E-Trade, even if you don't use E-Trade? Okie dokie. So now let's make it fun. Let's go over to an options chain. Got the option chain up. Now, there's a couple ways I can do this. The easy way is to open another market depth and link my options chain to it so that if I wanted to trade the Yahoo $35 calls for July 19th, you see up here the dates? These are my expirations. So if Coach Mike alerted Yahoo 7/19/35 calls, we could open the option chain, Click on July 19th. This pops up. Well, there's two ways to enter my order here. Now I'm going to maximize this so everybody can see it good. I could actually come down here where it says show order entry, click the box. I could type in the number of contracts I wanted, if I wanted to do 10 contracts. Type, well, it's a call, the expiration, July 19th, the strike. Scroll on down here and find 35. I could buy to open, price type, I want to do a limit. Let's see, the ask on that's 118. If I want in it, I got to buy the ask. So I'd buy 118, and I'd come over here and I'd click submit. The other way to do that is to link your option. I can click right here. I'm just going to click it. And on my market depth, Yahoo, July 19th, $35 call. And now I can enter my order just like I would the stock trade order. I could buy 10 contracts on a limit. The ask is 118. I could click buy open. If I wanted to sell it, how would I sell it? Okay, so I'd click sell to close. But if I've got 10 contracts, and looking at the level 2 right now, how would I have to sell it to make sure I could get out with one order? Would I sell it at 113? Because that's the bid. Well, 111's got 10 on it there. So I could go down to 110 or 111 or to 110 to ensure that I could get out. So the bid would absorb my sell, right? Well, yeah, don't you want to make sure you can sell them, Sam? Of course I look at the size. Size does matter. Now, the other types of orders you might want to look at is, hey, Coach Mike said, so we make our buy to open 118, but we're going to use a trailing stop. With E-Trade, I can do a stop on quote or stop limit on quote, but the trailing stop, that only gives you the dollar instead of the percentage. And it has to be a minimum of 0.1. Now what this does with E-Trade is it's based on the bid. So if I bought at 118 right now and put in a trailing stop of 10 cents and hit sell close, what would my initial stop order actually be? $103. Because E-Trade bases it off the bid price. They will base it off the highest bid that receives a transaction. If the price runs up to $1.50, but the bid only goes to $1.44, what will my stop then be? $1.34, that's right. On a trailing stop, your stop will readjust itself. So rather than just saying, hey, we're going to buy these at 118 with a stop of $1, well, if you're not sitting there watching it, it's going to suck if that $1 goes to $2 and all the way back to $1, right? So we can use a trailing stop to make sure we don't give too much back. Does everybody understand that? Sorta. Okay, Sam, a trailing stop is a stop that plays follow the leader with the price. And it starts at the point that you enter it. It doesn't base it off the high of the day from the time you're entering it. It bases it off the price right when you enter it. So if I did it right now, it would see that bid of 113. And it would automatically have a sell order, a stop order prepared at 103 if I used the 10-cent trailing stop. If my price went up to $1.50 and then my bid was at $1.44, it would trail, my stop would follow the price. It would go up as the price went up. And it'd say, oh, I've got to change that stop order to $1.34 now. So it's like a constantly adjusting stop out price. I've been told that before, Sam, that I've got a good way of explaining, getting through to people. It'd be entered after you buy. With some brokers, you can do like a conditional order that will let you buy it and enter the trailing stop right away. But it's no different than doing it this way. Okay? So, in essence, it's the same thing. And even if you were using a conditional order, you would still have to type it out, like enter it in the same way. Now, let me tell you where trailing stops are really good. And I'm going to be the first to admit that I haven't used stops with options for very long. For the longest time, I flat out refused to. I wanted to actually watch them, and there's been a couple times I've used trailing stops that it kind of hosed me out, and I wouldn't have sold if I didn't have a stop, or if I didn't have the trailing stop entered. But for the most part, it's been and I know a few people here, like Lancaster's one, that he's actually found a comfort level with it. Because if you find yourself having difficulty hitting the sell button on your losing trades, a trailing stop might be for you. If you're somebody that has a difficulty with your winning trades, you know, those that you see it hit a high and you're like, oh man, that might be the high, and then you tell yourself, okay, it went to $1. If it goes below 90, I'll sell it. And then it hits 89 and you're still holding. Has that been you before? Don't be ashamed. You're with family. It's been me. I've sat there and I'll see it hit $1. I'll say, okay, 90 will be my mental stop, and then I sit and watch it, and then I go, okay, maybe 85. If it goes below 85, I'll sell it. Before I know it, that thing I bought at 60 is back to 60, and I still don't know where I'm going to sell it, because what if it goes back up? And we got to be honest with ourselves. I could care less if you're honest with me. But be honest. Yes, Jerry. If you wanted to do a 15-cent stop, it'd be 0.15. If you wanted to do a 20-cent stop, it'd be 0.20. Using the trailing stop dollar, you're actually entering the dollar amount you're willing to dance with. Now, I really like trailing stops on stock orders. Let me go to one here that I have a trailing stop in for. Wells Fargo. If I wanted to enter a trailing for my Wells Fargo position, I could simply take and enter my 5,750 shares, price type, trailing stop percentage, And now the value isn't $1 a much. And I've got a 1% trailing stop right now on Wells Fargo. So let's assume I was entering that 1% trailing stop right now. 51.35 times 0.01. If Wells Fargo moves 51 cents, my stop will trigger. Do you understand that? But it'll be 1% from any high. So if it goes to 52.80, now it can fall 52 cents before it stops me out. And if it went to $100 without ever pulling back more than 1%, it could drop a full $1 before I stopped out. So when push comes to shove, what the trailing stop does is prevent you from giving a lot back. And you can use that in many different ways. One way would be, hey, I'm willing to take a 10% loss on any stock I enter, but I also don't want to give a lot back. Well, you know what? Enter a 10% trailing stop right when you buy it. If it runs up, if it falls 10% from that high, it'll sell. I like a 5 to 8% trailing stop on stocks, under 10 bucks, and above that, I usually use 3%. I didn't see what Lancaster said. Oh yeah. Well, you're talking about sometimes you can. Get stopped out and it runs. Is this where you just get back in? Yep. That's exactly what it is. Now, on stocks that you learn to watch and study, the first thing I would say is, and I think Jesse learned this, he put a 20-cent trailing stop in on something that he bought at 30 cents. So he put in a trailing stop for a 67% loss. That means that thing could have gone 100% and then come all the way back to where he bought it, essentially, before it stopped him out. I like the trailing stops more so on stuff. If I'm buying it for under 60, I wouldn't use anything more than 0.1. But if I'm buying it for $1, 20, 25 cents, yeah, that means I could take a 25% loss. But options are more volatile. You have to be willing to take more than a 5 or 10% loss with options. Certain conditional orders can be done with that, but conditional orders aren't offered by every broker, and I personally don't use them very often. If your broker offers conditional orders, the best way to answer that question, Tammy, would be to actually have your broker, whether it be on the phone or something, demonstrate how it should be done. But there are ways to do conditional orders. Like, I've used them in the past where stock hits a certain price, and I have them set sometimes on longer term options trades where regardless of the option price, the stock has to hit a certain price. but not every broker allows you to do the conditional trades. So I'm just wanting to kind of keep it basic. Now, another thing I did want to cover tonight is how you could do that using Thinkorswim. So it's primarily the same way for stocks and options. So I'm going to go over with an options chain. And there's many ways to actually buy and sell order to pop up using Thinkorswim. One way is if I wanted to buy something from the options chain, I could be like, oh, cool, we're going to do the 67 call. Well, it could pop it up like this just by me clicking the line. If I click the ask side, the ask column, it'll actually pull up a buy order. Buy, you enter the number of contracts. It usually defaults at 10. Yeah, let's make sure you're 67 put. If I'm on a limit order, and then what I want to buy at, confirm and send, give you a little box, says okay, you click it. If I want to sell it, I can click the bid side. You look, now it's a red line instead of a green line. So I could sell, those 10 contracts. Here where it says order, it's defaulted to limit. If I wanted to do a trailing stop, I click trail stop. And I could do it by, when you do it by mark, that would be the current price and then the prices that proceed from there. 10-cent trailing stop, if that's what I was using, confirm and send. So now, unlike E-Trade that bases it off the bid, Thinkorswim will base it off the highest price obtained, which is what E-Trade also does for a common stock. So if I had a 10-cent trailing stop, and when I entered it, the highest price obtained was 79, or that was the price that it was at the last transaction, what would my stop be? In the same example, E-Trades would be 67. And there you go. With Thinkorswim, it'd be put in at 69. It's important to know that, especially if you're like me and using multiple brokers. Where E-Trade can kind of hurt you is something like Goldman Sachs. Because many times Goldman Sachs has a good size spread. You look over here at the 172.50 calls, they're 13 by 20. If I bought at 20 and put in a 10-cent trailing stop with E-Trade, my stop would be 3. 0.3. You're going to have to reword that question, Sam, because I have no clue what you're asking. How about if you want to protect when you have ... question mark? When you have 2P? Well, that's what a trailing stop is. If I bought it if we go back to those Facebook options I was talking about, if it went up to $1.10, if I bought at 79, it runs up to $1.10. My stop is going to move up. That trailing stop will move up to $1. It plays follow the leader with the price. It just doesn't follow it down. So it'll constantly adjust. Does that make sense? Okay. So one final thing here. How do you pick your stop? You know, some places that probably shouldn't be teaching people how to trade would tell you your stop should always be a flat value. I would say that's not true because I've tried it that way. Sometimes I chase a stock because they tell me to buy it, and they tell me to always use a 10% stop. Well, I chased it when it was already 10% up. And yeah, it might drop 10%, it might drop 12% before it runs 50%. You ever seen that happen? And then you get an email that night from Jeff Williams that says, oh, I alerted this stock today and it ran 75%. Yep, but you told us all to stop out of it. And we've talked about this in many different ways in relation to different trading systems. But it's going to be based on knowing where your support and resistance is. Let's look at Facebook, for example. If I'm looking at buying Facebook for a long-term position, right now today, based off my daily chart, where is my support at? You know, we could say, oh, that gap fill, because we're trained to say a nice area to maybe buy something on a bounce. But really, it's down here at 62.21. Oh, wait, I lied. It's actually down here at 61.79. Why? Think very, very basic. This is the last low that resulted in a higher high. And on your long-term positions, you want to trade in relation to your stop, or else you find yourself, yeah, you might not get a good price, and then it falls a little bit, you stop out. So you buy it again when it looks like it might bounce, and it falls a little bit, so you stop out, and your broker's just saying, man, I love this idiot. But this was the last low that resulted in a higher high. Now, it would have been like right here, had this not happened. And it is possible slow if it does what? If Facebook does what? A long-term stop would be moved up to the low of this candle. Yeah. If it breaks over that. And then somebody that's been in it since down here would say, oh, cool, I got to raise my stop again. And they put their little pretty line on their chart. Look, honey, now if we stop out, it'll be a higher price than it was before. Very simply, with longer term positions, the simplest way to trade them is in relation to their lows and highs. Now, if I was going to enter a position right here, knowing that I just pulled back on a double top, Sam, stay with me and don't confuse yourself. If I bought today knowing that, hey, I just pulled back from a double top, and this was a position I wanted to start building for the long term, wear it with a full position, or based on what I'm willing to lose down to where the actual stop would be. The answer is smaller position based on an amount I'm willing to lose according to the stop. The reason is if you're building a long-term position, you're building long-term positions for reasons of conviction in a stock, for stocks you've researched. You believe Facebook will continue upwards because whatever. And you don't want to find yourself buying, selling, buying and selling, buying, selling, buying, selling, buying, selling, because then you're not building a long-term position. Matter of fact, you're running around like a chicken with your head cut off. That's quite simply what you'd be doing. And you wouldn't just want to set some random trailing stop on something like this, because then you would get something completely random that could just be something that it bounced from. And ironically, those same types of principles would apply if I was looking at it on a 15-minute chart. Okay, this here was my last low that resulted in a higher high. And I want to day trade some calls. Okay, it's coming down, it's coming down. You know what? But it could come down to here. Am I willing to let it come down to here when I enter calls for a day trade? That's a question you have to ask yourself before you enter that day trade. Because in all reality, you could enter the calls here, it dropped down to there, and it still be a good trade. And how could you figure out what type of stop to put on that? Oh wow, I'm buying this at 66.80 or when it's at 66.90, knowing it could fall to 66.50 and still be a good trade that I made. I just maybe didn't get the best price. What could I use to figure out what would be a good trailing stop price, or a hard stop, like a stop limit or a stop on quote? What could I use? Starts with a D. It's one of the Greeks. See, if the stock was at 67.90 when I bought it, and I knew it could fall to 66.90, 66.90, and I knew it could fall to 66.50, it's 40 cents. Let's say my delta was 0.1. Multiply that by your delta. And let's say you bought something for, hell, 30 cents. Or actually, we'll say 50 cents. Well, at the 0.1 delta, that's going to be a pretty low delta for that big of a move. But actually, let's go with point. We knew we had 40 cents there times 0.5. Well, more times than not, rather than even factoring out like the, oh, okay, that's 20%, so at 0.5, that'd be a 10-cent trailing stop. If you didn't want to do that, you could say, okay, I'll just put in a 0.2 trailing stop. It'll get you close enough. Or if you wanted to enter that quickly and then figure it out and then get it entered, that's what you'd be looking at. But you're going to be better off in your trading by not making up a stop, rather knowing where the stop is and basing your stops off support. You could do the same thing looking at a 5-minute chart. I had a low that resulted in a higher high. I got a lower low, that resulted in a lower high. What kind of trade is this on this candle? It could have been a puts trade, right? So this candle starts dropping down. Where's my stop? This line right here. You wouldn't want to make it here and still be in those puts. You wouldn't want to make it clear up here and still be in those puts. You definitely wouldn't want to do it clear up here and still be in those puts. But that is an appropriate stop right there for a scalp trade or a day trade. You base it on what the intraday charts are showing you. So it's very, very important to know where, rather than going, oh, you know what, if it drops 5 cents, I'll sell it. Because what almost always happens when it drops 5 cents is either A, you don't sell it like you plan to, or B, you sell it and it runs. Why? Because it was still within the confines of the trade you made. And then there's sometimes, even when you do it this way, that it still doesn't work out. You sell it and it runs. You buy it and it drops. But when you do it this way, more times than not, you'll make the better trades. More times than not, if a stock were going to remain bearish, it won't make a higher high. More times than not, if a stock is bullish, it won't make a lower low. More times than not, if you base your stops off what the chart tells you, as opposed to just some random made-up number, and enter the trade based on the same capital that you may be willing to risk, which could mean making a smaller position. But basing your stops off what the chart says, you'll give yourself the opportunity to stay in trades that even if you didn't get that good of a buy on, may have still been a very good trade to have made. Very simple tools to help you with that. Because just entering random stops And I've done a lot of random stops. I've done a whole lot of, well, you know what? If that thing drops 10 cents, I'm going to sell it. It drops 10 cents, I sell it, and it was like, son of a gun, I was the absolute lowest sell there. Thanks, random made-up number that I should have never used. Thank you. So I wanted to go through and demonstrate just some basic orders, and then also kind of make a basic note on understanding what your stop point should be rather than just a made-up number. And I see it more so with newer people than people that have been around longer. And then I see them get stopped out of a trade and then send me a private message like, man, I had my trade plan, and it said if it dropped 10 cents, I would sell it. It dropped 10 cents, I sold it, and it only dropped 10 cents before it ran again. I was the lowest sell, and it happens to me every time. And I tell them, well, you're just making up a random stop point. The chart will tell you where your stop should be. And one of the benefits of doing something like studying less charts so that you can make higher quality trades on them is you won't be getting it super far off of where your stop would be if you're actually following that chart like you should be. To pick on Dan for a second, the British one that lives in Chicago, Amazon said that if you were going to chase it, you had to chase it on the breakout. Not 25 bucks above it, 20 bucks above it. But that you have to have the courage to do it when it does it. Why didn't I have the courage to buy on the breakout a couple days ago? Because I bought it there. So I didn't need to worry about buying it here. And we don't want to catch ourselves over trading either. Because in reality, through all of this, 3 weeks of just nothing, Amazon did not give me a reason to sell it. Well, that might be a reason to sell it then. If Kramer talked about it.